Hello all the viewers. Welcome to DevTech Finance and here's another video on derivatives. So let's get started with the agenda for this video. In this video we would be covering Introduction to Derivatives as a Financial Security, Ways to Trade in Derivatives, Types or Products in Derivatives like the forwards, futures, swaps and options, Participants in Derivatives which are hedgers, speculators and arbitrageurs, and at last we would have a look at the significance of derivatives. So let's start with the introduction. Derivative is a financial security in the form of contract whose value is derived from an underlying asset. The buyer agrees to purchase the asset in future on a specific date at a specific price. Thus, it is a contract between two or more parties and its price is determined by fluctuations in the underlying asset. So let me make this simpler for you to understand. So what is happening? Derivative is a kind of contract or agreement being formed between the two parties, which one is the buyer and one is the seller. So for example, the seller is having the stocks of Reliance Industries Limited, whose today's market price is approx 1300. Now they form the agreement or between seller and buyer is formed that after 6 months the seller would be selling the RIL stocks at 1400 regardless of the market value of RIL stocks at that period of time, and the buyer agrees to that. He agrees to buy at 1400 after 6 months. So what is happening? The contract is being formed at present period of time at a specific price which seem to be correct by both the sellers and buyers point of view, by both of them's perspective according to the market fluctuations, and regardless of the market value of the asset at that period of time, they are forming an agreement to do the trading at the specified price at today's period of time. So why they are coming into such an agreement and how it would be a profit or loss for any one of them? So see, the seller decided to sell the stocks at 1400 of RIL Limited after 6 months. So what happens is that seller is thinking that after 6 months, looking at the market conditions, he predicts that the prices of RIL stocks may go down. So it's better to form a contract today at 1400 because it may go down to 1200 or 1100. So if I form a contract today at 1400, it would be beneficial for me at that period of time after 6 months. So this is seller's perspective according to the market predictions of him. And what is the buyer thinking? So the buyer is thinking just opposite of the seller. He is thinking that the RIL stock prices may go high after 6 months. So it's better to buy the stocks at rupees 1400 per share after 6 months by deciding the price at today, by forming a contract at today, because if the prices go higher, for say it would be 1500 or 1600, it would be costlier for me to afford. So it's better to form a contract at 1400. So this is buyer's prediction about the market because of which he is forming an agreement, and the seller's perspective was just the opposite. So this is how both the seller and buyer is making predictions and trying to earn some profits out of it by making an agreement for future for the future period of time at a specified price on current period of time. So this is how derivative is forming its role. So these derivatives are based on wide range of underlying assets. Like it could be any financial asset such as shares, bonds, debentures. It could be metals such as gold, silver, aluminium, copper, lead, zinc, tin, etc. It could be energy resources such as coal, oil, natural gas, electricity, and it could even be agri commodities such as wheat, cotton, pulses, sugar, etc. So these derivatives extracting the value out of the underlying assets and what these assets could be. So it could be any kind of financial assets, commodities, metals, or energy resources. Now, ways to trade in derivatives. So it could be an over-the-counter trade or it could be an exchange traded derivative. So how these both are different? Over the counter trade means the contract or the agreement is being formed between the buyer and seller directly. So they are just meeting over the telephone conversation or over face to face. They are just forming an agreement. They are just forming a contract or agreement for any of the stock or bond in form of derivative. But when the same agreement or contract is being formed through an exchange, so that is called exchange traded derivatives. Like the derivatives are listed on the exchange and order is being placed and purchased from there, so it would be an exchange traded derivatives because it is traded through the stock exchange. Let's have a look at the products and derivatives market. So the first one is forwards. Forwards, it is a contractual agreement between two parties to buy and sell an underlying asset on a specified future date for a particular price that is pre-decided on the date of contract. So my example which I gave about the RIL stocks which the seller is ready to sell after 6 months and the buyer is ready to buy after 6 months at the pre-decided price on current period of time which was 1400 regardless of the market value, which is today's for today was 1300 and may be fluctuated in upcoming future, may go high, may go low. So if they are forming such a contract, that contract is known as forward contract. Both the contracting parties thus forms an agreement and are obliged to honor the transaction irrespective of the market price of the underlying asset at the time of delivery. So you must have understood through this example that they are coming into a kind of agreement, they are coming into a kind of contract. So it is making somehow them obliged to do the transaction at the decided period of time. So maybe at that period of time, the prices of stocks of RIL have gone up. So it may be loss for one of the party, and if it goes down, it may be loss for one of the party. So regardless of that market value at that period of time, whatever the contract has been formed at today's period of time, they are obliged to do that transaction. Since forwards are negotiated between two parties, the terms and conditions of contract are customized in accordance with both of them. Let's see futures. A future contract is similar to a forward contract except that the contract is made through a regulated exchange rather than being negotiated directly between two parties. So when we talk about forwards and futures, the basic difference is that forwards is more about OTC, which we just saw, over the counter market. So it was directly deal between buyer and seller, whereas future is ETD, that is exchange traded derivatives. So it is being regulated through exchange. Futures are exchange traded forward contracts. We can say that in a more simpler, meaningful manner that these are exactly the forward contracts only. The meaning is same, but the only difference is that these are traded on exchange rather than directly between the buyer and seller. Let's have a look at the options. An option is a contract that gives the right but not an obligation to buy or sell the underlying on or before a stated date at a stated price. So you know what happens is that now taking the same example like RIL stocks, about the RIL stocks. So if the price was going high, it was beneficial for the buyer, and if the price was going low, it was beneficial for the seller. So what is happening that both the parties are having some sort of benefits in accordance with the market fluctuations of the underlying asset. Now if any one of the party goes in loss, what that party would do? So for example, if the buyer goes into loss, so what buyer would can do? It could have an option. So option would would give the right to sell the underlying before the stated date at a stated price. Now to recover that loss, the buyer could buy an option. To buy that option, it pays the premium and buys the right. And if the seller of option receives the premium with obligation to sell or buy the underlying asset if the buyer exercises his right. So you know what's happening is that option is acting a kind of insurance. So there is some sort of risk that yes, we have formed a agreement, we have formed a contract, but maybe at that period of time my predictions goes wrong. So I found an agreement that I would be ready to buy the stocks at 1400, but maybe that at that period of time the stock prices come to 1200 for say. So I am ending up paying 200 more. So that is making a kind of loss on me as a buyer. So how can I cover that risk? How can I cover that loss? So option provides that way to cover that loss. What happens is that the buyer pays the premium to buy the option and the seller of option receives that premium. So some kind of premium is being paid so that at that point of time, if my agreement goes against me and not in favor of me, I don't end up losing more. I can have that premium insurance with me to cover my losses. So this is what options comes into play in this derivatives market. So in simple words, it's a kind of insurance being provided to cover the risk. When you are paying the premium to cover the risk involved in the market, if your predictions goes wrong and if the values of the underlying asset which you predicted may goes against you. Let's have a look at the swaps. A swap is an agreement made between two parties to exchange cash flows in the future. Swaps helps market participants manage risk associated with volatility, mainly in interest rates and currency exchange rates. Okay, so swaps are mainly a kind of agreement between two parties to exchange their cash flows. Now, two of the major swaps which exist in our derivatives market is interest swaps, and currency swaps. So, talking about the interest swaps, what's happened is that, for example, see, interest rate swaps perform to switch from floating interest to fixed interest and vice versa. So there are two parties. One is having a loan on which he is paying a floating interest, which is a variable interest that is according to the market. If the interest goes high, he would be paying higher interest. If it goes low, he would be paying lower interest. On the other hand, there is another party who has taken the similar loan of similar amount but is paying the fixed interest. So the fixed interest is not affected by the market fluctuations. Now, both the parties decided that they would swap their interest rates. And why is that happening? Because they think the party holding fixed interest rate thinks that the floating interest rate would be better because, the market are so fluctuating, it is going down, so it would be beneficial for me if I end up paying lesser interest rate according to the market. On the other hand, the other party who is having floating interest rate thinks that the market is quite fluctuating, so it may go high. So I would end up paying more interest rate in accordance with the market situation. So it's better to have a fixed interest. So both the parties are having different perceptions about the market and they wanted to exchange their interest rate. They wanted to swap their interest rate. So this is what swaps comes into existence in derivatives market. When the two parties, for example, who have taken loan of similar amount and are having different interest rates, they could just swap their interest rate and the interest rate would be paid. The interest rate of one party would be paid by the other party and the principal amount would remain same. Now let's have a look at the participants in derivatives. So the first one is hedgers. Hedges, they face risk associated with prices of underlying assets, use derivatives to reduce their risk. Corporations, financial institutions, and banks all use derivatives products to hedge or reduce their exposure to market variables such as interest rates, shares values, bonds prices, currency exchange rates. So hedges, these are just the participants in derivatives market. Okay, so hedgers are the one who forms an agreement at today's point of time because they are trying to minimize the risk associated with the market fluctuations. So many of the banks, many of the financial institutions, corporations all uses these derivatives products to reduce their exposure to market risk so that they are suppose that they are having an agreement that the interest rate would remain at 8% regardless of the market fluctuations, and thus they are safeguarding the interest of all those depositors, all those holders in the bank account. So this is how hedgers are doing, participating in derivatives market. They are trying to minimize the risk because market fluctuations are always coming with some sort of risk. So if the price is determined, if the price is fixed, obviously they are covering all those risks related to the market. Then the speculators or traders are the one who try to predict the future movements and prices of underlying assets, and based on the view they take positions in derivatives contract to earn maximum profit. So when we talk about speculator or traders, so these are not like hedgers. They are not trading in derivatives market to cover their risk associated with market fluctuations. Rather, they are trading in derivatives to earn maximum profit in shorter period of time. So these are the speculators or traders because they are trying to predict the future movements, and according to that they are forming a contract in expectation that they would be earning a maximum profit out of their predictions, out of their expectations, out of their assumptions about the market. Then there is arbitrageurs. When we talk about arbitrage, it is a deal that produces profit by discovering a price difference in same product in two different markets. So just with the meaning of arbitrage, we can understand what is the main functioning of arbitrageurs in derivatives market. So these are traders who purchase an asset cheaply in one location and manages to sell at higher price in another location. So when we talk about, there are different markets, the cash markets, the derivatives, the equity market, the bond market. So what arbitrageurs are doing, they are holding one sort of asset, one sort of stock, and when they see that there is some kind of difference in the price of that asset in different markets, so they would just sell the stock at higher price in another location, the same stock. So they are kind of speculating at different markets with same stock to discover the price difference and thus earn profit out of it. So these traders are then called arbitrageurs. So we have seen the participants in derivatives are like hedgers, speculators, and arbitrageurs. Let's have a look at the significance of derivatives. Derivatives market facilitates price discovery based on expectations and actual valuation. So it's very clear, whatever we have discussed till now, it makes very clear that the price discovery that is happening based on the expectation and actual valuation of derivatives of the underlying assets. Derivatives market helps transfer of various risks. Derivatives market helps stop speculative trades from unorganized market to organized market. So we have seen the exchange traded market, which is a more organized sector, which is allowing the trade in derivatives. And then it also acts as a risk management mechanism. And this is the reason why we saw many of the banks and corporations act as a hedgers in the derivatives market to manage the risk because of the market fluctuations. So this was all about this video. I hope you understand clearly about derivatives, the types of derivatives, the participants in derivatives, what does exactly derivatives mean, and lastly the significance of derivatives. Thank you for watching. Do like and share my videos and subscribe to my channel DevTech Finance. Thank you all.